Picture two people sitting in the same break room at the same company on the same Tuesday afternoon. Both of them are 28 years old. Both of them take home roughly the same paycheck after taxes. Both of them have been meaning to start investing for about 3 years. The first one, Zane, opens his phone during lunch, reads one more article about market valuations, watches one more video about the coming crash, and decides today is still not quite the right moment. He has been making this decision for 37 months. The second person opens a brokerage app, sets up an automatic monthly transfer into a broad index fund, and goes back to eating his sandwich. The whole process takes 9 minutes. 30 years from now, the sandwich person retires comfortably. Zane, who spent 3 decades researching the perfect entry point, ends up with less than half as much money despite earning the same salary, living in the same economy, and having access to the exact same investments the entire time. The gap between them has nothing to do with intelligence. It has nothing to do with market timing or stock selection or financial genius. It has everything to do with one person getting out of his own way and one person never quite managing to not to. This script is about how to be the sandwich person. Specifically, how Zane would invest if he were starting from absolute zero in 2026. What order, what accounts, what funds, and why the answer is both simpler and more counterintuitive than most of the financial content on the internet will ever admit. First, the honest context about 2026. Before touching a single dollar, Zane needs to understand the environment he's investing into. Because anyone building a beginner guide who skips this part is doing you a disservice. The American stock market has delivered exceptional returns for several consecutive years. As a result, U.S. stocks are currently trading at valuations that rank among the most expensive in more than a century of recorded market history. A measurement called the Shiller-Cape ratio, which compares stock prices to the inflation-adjusted earnings those companies generate averaged over a decade, sits dramatically above its long-term historical average. Additionally, the market has rarely been this concentrated. A handful of enormous technology companies now represent an outsized share of the entire index. When you buy a broad U.S. market fund today, you are making a significant implicit bet on a small group of very large technology businesses continuing to perform at extraordinary levels. Major investment institutions have adjusted their forward returns projections for U.S. stocks downward from historical averages as a result. Zane read all of this and had the completely natural, completely human response. He thought he should wait for the crash. Here's why that instinct, however reasonable it feels, is the single most expensive mistake in investing. Going back through every period of apparent overvaluation in modern market history, the investors who waited for the correction to materialize before buying frequently waited through years of additional gains they never captured. More importantly, research tracking what the market has returned over every 20-year period in its history, including periods containing the Great Depression, multiple wars, the dot-com collapse, the 2008 financial crisis, and the pandemic, reveals something that should permanently settle this debate. Over every 20-year holding period in American market history, a diversified investor has never lost money in inflation-adjusted terms when dividends are included. Not once. The market has an undefeated record against 20-year patience. It has a very poor record against people who keep waiting for the right moment. Expensive markets do not mean you wait. They mean you stop gambling on individual stocks and concentrate on the boring, diversified, low-cost approach that performs across all environments. Why your money is already losing without you noticing. Here's what's happening to Zane's money right now while he waits. Inflation is running meaningfully above what standard savings accounts pay. The average traditional savings account at a major bank pays somewhere around 0.33% annually. Inflation is running several times higher than that, which means every dollar Zane keeps in a standard checking or savings account is losing real purchasing power every year automatically without any crash required, without any bad decision, simply through the passage of time. $10,000 sitting still in a regular account for a decade does not stay $10,000 on the screen, while quietly becoming worth significantly less in terms of what it can actually purchase. Standing still is the bad decision. The goal of investing is not to get rich. The first goal is simply to stop losing ground to inflation without realizing it. Everything beyond that is acceleration. Before the market, 2 unglamorous steps. Zane wants to skip straight to picking investments. Everyone does. The people who skip what comes first are the ones who end up selling their index funds at a 30% loss 2 years later because their transmission died and their account was the only emergency fund they had. So before buying a single share of anything, 2 things happen first. The first is high-interest debt. If Zane is carrying a credit card balance at 22% interest, paying that off is mathematically identical to finding an investment that guarantees him a 22% tax-free return. No investment on earth reliably beats that. Not the stock market at its historical average, not real estate, not anything being promoted on social media. Every dollar of high-interest debt eliminated is the highest returning financial move available to him. The general threshold Zane uses is this. Any debt above roughly 7% interest gets eliminated before serious investing begins. Below 5%, investing alongside the debt makes sense. Between 5 and 7 is a judgment call that should be made based on whatever produces better sleep. The second unglamorous step is the emergency fund. 3 to 6 months of essential living expenses sitting in a high-yield savings account. Not a standard bank account, but one of the online options paying several percent annually, which in the current rate environment represents a meaningful difference. The emergency fund is not a savings product, it is armor for the investment portfolio. Market crashes and personal financial emergencies have an almost comedic tendency to arrive simultaneously. A job loss, a medical expense, a major car repair, these have a habit of appearing in the same season as a significant market downturn. Without the emergency fund, Zane would be forced to sell his investments at exactly the wrong moment, converting a temporary paper loss into a permanent real one. With the emergency fund fully in place, a crashing market becomes something he can watch from a distance while doing nothing. The ability to do nothing during a crisis is the most valuable capability in investing. The emergency fund is what purchases it. One practical note, Zane does not need the full emergency fund before beginning to invest. That could take years, and time in the market is genuinely irreplaceable. 1 month of expenses as an initial buffer, elimination of toxic debt, and capturing the employer match, which comes next, can happen simultaneously while the rest of the emergency fund builds. The only free money in the financial system. Zane's employer offers a retirement account match. For every dollar Zane contributes up to a certain percentage of his salary, his employer adds additional money. This is an immediate guaranteed return on his contribution before the market does anything whatsoever. There is nothing else like this anywhere in personal finance. And yet, a significant portion of eligible employees do not contribute enough to capture their full match. The mechanics are simple. Zane logs into his company's retirement account portal and confirms he is contributing at least the percentage required to receive the full employer match. If he is not, he adjusts it today. This is the first move. Nothing else happens before this. The account order that changes everything. Most investing conversations skip straight to what to buy. The more important question is where to hold it, because the same investment inside different account types produces dramatically different outcomes due to how each account is taxed. Zane works through a specific sequence. The first account is the employer retirement account, funded up to the full match as described above. The contribution limit in 2026 is substantial, but for now the priority is simply capturing every dollar of the employer match. The second account, and this is one most people have never heard of, is the health savings account. If Zane is enrolled in a high-deductible health insurance plan, he qualifies for what is quietly the most tax-advantageous savings vehicle available to ordinary Americans. Money goes in without being taxed, it grows without being taxed, it comes out without being taxed when used for medical expenses. Most other accounts make you pay tax at the entrance or the exit. The HSA somehow avoids both. The strategic approach is to invest the HSA balance in index funds, pay current medical expenses out of pocket, save every receipt, and allow the account to compound for decades.
After 65, the account can be withdrawn for any purpose and simply behaves like a standard retirement account, except there is potentially decades of receipts that can be reimbursed tax-free at any point. The third account is the Roth IRA. Zane opens this himself at any major brokerage in the time it takes to order lunch online. The contribution limit in 2026 is several $1,000s annually for most income levels. The deal is straightforward. Pay tax on the money now, contribute it, let it compound for decades, and withdraw everything, including all growth, completely tax-free in retirement. For someone early in their career, likely in the lowest tax bracket they will ever occupy, paying tax now in exchange for never paying tax again on decades of compounding is one of the most favorable financial trades available. The fourth priority is returning to the employer retirement account and working toward the annual maximum contribution limit. The fifth, once everything above is funded, is a standard taxable brokerage account with no special tax advantages, but also no limits and no restrictions on access. The sequence in order: employer match, high-interest debt elimination, emergency fund completion, HSA, Roth IRA, remaining retirement account capacity, taxable brokerage. That order alone places Zane ahead of the substantial majority of American investors before he has selected a single investment. Now that the accounts exist, the question is what to put in them. Zane spent considerable time thinking he needed to identify the right individual stocks. He no longer thinks this. Here is the research that changed his mind. An extensive study examining every U.S. stock since 1926 found that the majority of individual stocks, more than half, underperformed one-month Treasury bills over their lifetimes. The legendary wealth created by the American stock market over the past century was generated by a remarkably small percentage of companies. A tiny fraction of businesses produced essentially all of the market's long-run gains. The rest collectively barely kept pace with the most conservative investment available. Stock picking, therefore, is not the exercise of selecting good companies. It is the exercise of trying to identify, in advance, the specific 4% of companies that will generate essentially all of the returns, from a pool of thousands, while the other 96% collectively go nowhere. The professional fund managers whose entire careers are dedicated to exactly this task fail to beat a simple market index over 15 and 20-year periods at rates exceeding 90%, not because they are not intelligent or hardworking.
Because the market is extraordinarily efficient at incorporating available information into prices, making consistent outperformance through research and analysis nearly impossible to sustain. The solution Zane arrives at is the index fund. Rather than selecting needles from the haystack, he buys the entire haystack. One broad market index fund makes him a fractional owner of every significant company in the economy simultaneously. He cannot miss the 4% of companies that generate all the returns because, by definition, he always owns them. He will never beat the market, and he will never lose to it. He will simply receive what the market produces, which, per the data above, beats roughly 9 out of 10 professional managers over his investing lifetime. The specific funds Zane uses are straightforward: a total U.S. stock market index fund with an expense ratio of a few hundredths of a percent annually, an international stock market index fund covering developed and emerging markets outside the United States, a total bond market fund for stability. These three holdings together represent essentially the entire investable global economy at a combined annual cost of less than 0.5%. Alternatively, and Zane genuinely considers this the strongest option for anyone who wants to minimize ongoing decisions, a single target date index fund with his expected retirement year in the name does everything automatically. It holds domestic stocks, international stocks, and bonds in appropriate proportions. It rebalances automatically as markets shift. It gradually becomes more conservative as the retirement date approaches. One purchase, one fund, complete diversification, nearly zero ongoing maintenance required. The fee matters enormously over time.
The difference between a fund charging 0.03% annually and one charging 1% annually on the same underlying investments in the same market over the same 30-year period can represent several $100,000 of final wealth. Fees are the only variable in investing that compounds against you with absolute mathematical certainty. They deserve the attention most investors spend on stock selection. The behavior problem nobody solves with research. Here is the part of the investing conversation that most guides skip because it is uncomfortable. Every year, research tracking the difference between what the stock market returned and what the average individual investor actually earned reveals a significant gap. The market delivers a certain percentage, the average investor captures meaningfully less. Not because of fees, not because of bad fund selection, because of behavior. Investors buy after markets rise and sell after markets fall. They sit in cash waiting for clarity and miss the recoveries. They react to headlines with their portfolios and consistently make the opposite of the optimal decision. Research examining what happens when investors miss only the 10 best single days in a 20-year market period, 10 days out of approximately 5,000 trading days, shows their returns collapsing from outstanding to mediocre. And those 10 best days cluster immediately adjacent to the 10 worst days. The moment that feels most justified for selling after a terrible week during a frightening news cycle is statistically the moment most likely to precede one of the explosive recovery days that the entire long-run return depends on. Zane solves it not through discipline or willpower or superior emotional control. He solves it through automation. His monthly transfer transfers automatically the day after each paycheck arrives. His investment purchase executes automatically. His emotions are structurally removed from the process because the process does not consult his emotions. When the market drops 30%, and it will, the question is only when. The automatic transfer keeps running. Each paycheck buys more shares at lower prices. The red numbers on his screen are only real losses if he sells them. He has decided in advance, while calm, that he will not sell them. He has written this down somewhere accessible so that the version of him at 2 in the morning during a market panic can be reminded of the decision made by the version of him who was thinking clearly. What Zane's starting point actually looks like. Zane earns a reasonable salary. His employer matches retirement contributions up to a certain percentage. He carries a modest credit card balance that has been bothering him for 18 months. He has a small amount in checking that does not constitute a real emergency fund. His investing strategy until recently has been a combination of intention and avoidance. Month 1, he adjusts his retirement contribution to capture the full employer match and opens a high-yield savings account for his emergency fund starter. Every remaining dollar above basic expenses goes towards the credit card. By month 8, the credit card is gone. He has eliminated the highest returning investment available to him. Months 8 through 16, the same monthly amount that was going towards credit card debt now builds his emergency fund to a level representing several months of essential expenses. Month 17, he opens a Roth IRA, sets up an automatic monthly investment into a target date index fund, and closes the app. He checks it quarterly. He changes nothing when the market moves in either direction. He increases his contribution amount when he receives raises, maintaining the habit he built when the numbers were smaller. 30 years later, the math has done things that would have seemed implausible to the version of him eating lunch in that break room, wondering whether now was the right moment. The market was not safe when he started. No year ever is. The people who built wealth through the stock market did not start in safe years. They started in whatever year they happened to be ready, and they stayed long enough for the math to work. The only question that ever mattered was not whether the market was fairly valued. It was whether Zane would still be invested when it finished doing what it has done in every decade of its existence. He is. If this gave you a clearer picture of exactly how to start,
Hit the like button and subscribe to Wetrix Invest, because next time we're going even deeper into the mechanics of building real long-term wealth, and that's a conversation worth being present for.